Want to get some broader thoughts on Greece, business conditions, and the global economy as well. Our guest host today is Don Peebles, the chairman and CEO of the Peebles Corporation. He joins us this morning for the remainder of the show. What should we make of this, Don? What should we make of all this?
Well, the world's unstable, and Europe is one of the reasons that our economy is having this drag is what's going on in Europe and the impact that Greece is going to have. France stepped up the other day, indicating that they were going to stretch out their bonds that they have, the Greece bonds they have for 30 years. Other countries, other European nations have tremendous exposure to Greece, and they have their own problems too.
Right.
And so, does that mean that other countries are going to be in jeopardy as well financially? We're just in an unstable environment when you look at what's happening in the Middle East as well. Not good for the U.S. And one of the things that I noticed last week, I was in a store in Nantucket, and I heard this person explaining to their child, "Oh, we've got to buy American. Let's buy American." Well, that's an outdated way of thinking, because if we approach the world that way and we just buy American products, we're selling American products all around the globe, and the globe is buying our products, and we need them to buy more of it. And that's one of the silver linings in a weak dollar right now, is that our products are still affordable. But the challenge is that our economy is more linked now to the global economy and not just what happens here. And again, that's part of the reason why we're not seeing greater progress in our economy right now.
As someone who's in a business where there's a lot of leverage, right? I mean, you got to make big bets with credit on things that are going to fail or succeed years from now. How do you think Greece should be resolved? I mean, to the best it can be resolved. Does austerity, is that the
bondholders have to take a haircut?
I think the bondholders have to take a haircut. Look, General Motors bondholders took a haircut. And other bondholders, AIG bondholders, took a big hit. The reality is bonds are investments, and they're not without risk. And so consequently, when you make an investment, sometimes it works out well. The probability of default is minimal, but sometimes defaults take place, and you got to take that risk. I'm a big believer that there should be consequences. The other thing, though, is what we just heard is that they're talking about, there's a debate about reducing spending and reducing taxes. That debate is here too, and we really need to look at that in the U.S. in terms of how we control spending.
But before we even go down that road, let's go back to what you said about how the bondholders have to take a haircut and how austerity measures probably have to go through too. You probably need both these things in conjunction to make up for the amount of money that's been spent that's gone. But the idea that once you default as a sovereign nation, which some people say, the ratings agencies say, that would be a default, even if the creditors say, okay, we're going to extend the terms voluntarily. Once you default, it's very difficult to get the private markets to ever come back and lend again. Look at what's happened to Argentina in some of these cases. I mean, obviously we can't keep saying we're going to bail everybody out and nobody's going to lose any money on this. But it doesn't necessarily solve the problem either, and Greece is going to face a very difficult road.
Well, I think, look, Lehman Brothers is actually doing business in different forms right now. Businesses that fail, that go into bankruptcy, look at Texas Air. Look what happened there. Look at the Latin American debt and the Latin American economies in the 1980s, what happened then, and how, and some of those nations, what their credit looks like today. If Greece makes fundamental changes to what brought them to this brink of disaster, then I think the private sector and the free markets and the world markets would respond favorably. There's no one bats 100%. People make mistakes. Countries make mistakes. Economic circumstances change. The key is to make adjustments, to recognize that this isn't working, make adjustments, and also everybody kind of shares the pain.
So the French banks have been ignoring all of this and not marking down any of the money that they should have been marking down?
Yeah, I think be kind of kicking the can down, the road, sort of like what the U.S. banks have been doing for the last, 3+ years on real estate.
It's amazing how it's not exactly the same, but it rhymes, no matter what part of the globe you look at right now, right? It does rhyme. We didn't get to the debt ceiling debate here, but we're going to, because you're here for the next couple hours. We appreciate that. Don Peebles is our guest host today.
All right. In the meantime, the debate continues here in the United States between Democrats and Republicans over the debt ceiling increase. Joining us right now, Republican Congressman Tom Price, who's the chairman of the House Republican Policy Committee, also a member of the Budget and Ways and Means Committees. Also weighing in this morning, our guest host, Don Peebles. And Congressman Price, welcome. Thank you for joining us
Wonderful
this morning.
to be with you. Thank you.
We've been going going back and forth about the debt ceiling, trying to get our arms around it and figure out where the situation stands.
Sure.
This morning, Morning Money from Politico has some new words that are coming out from the Treasury, some new talk about why they think this is so imperative and has to get done. They say, first of all, the U.S. has made these promises already based on budgets that Congress has passed, so we need to pay these things. Second of all, the argument that we can pick and choose which of our bills to pay and our creditors won't notice that we're not paying some of those bills, they think that's a specious argument.
Yeah.
What do you say back to that?
Well, I think the Treasury actually did themselves no favors in moving from the May 16th date to the August 2nd date. What Geithner did in that instance was just give those folks who believe that these numbers really aren't firm greater credibility. Look, at some point we will pierce the debt ceiling, whether it is August 2nd, whether it's August 9th, whether it's August 15th, who knows. But the fact of the matter is we can't continue business as usual. We can't continue spending money that we don't have without structural changes put in place to get us on that path to balance. And that's all that we're saying. We would hope, we would challenge the president to recognize the remarkable difficulties that we have and say, yes, we've got to change course. We can't continue business as usual.
Although the problem becomes the two parties have very different ideas about how to change course. There are some who say you need to raise revenue. That's the only way to do it, particularly when revenue's been running at 15% of GDP versus the 18% normal. There are others who say, wait a second, we've got to bring our spending back down. Obviously, that's where the Republicans have staked their claim. We've gotten out of context and out of whack with historical norms on spending levels, too. So how do you find a compromise between those 2 points?
Well, I think you listen to the American people. The American people understand and appreciate that we're not in this boat because we don't tax enough. They know that we tax enough, and many believe we tax too much. We're in this boat because we spend too much, and we've got to get our fiscal house back in order. We believe, and we put forward a very coherent, optimistic plan about how you get a budget in balance, how you begin to decrease this spending, how you get to a point where you have a balanced budget and you can begin paying off your debt through fundamental reform of entitlements, through making certain that you decrease spending right now and you have a cap, you make it so that we aren't spending beyond the historical norms of 18.5% to 20% of GDP.
Well, Congressman, can you tell us then, because I agree with you, I think we've got to get spending under control, but I'm not sure the American people don't, there's a large chunk of the American people that think the affluent people, like companies like mine, aren't paying enough in taxes. So that's not as clear of a debate, but I think what is clear is that we can't afford to keep spending what we don't have. So in terms of fundamental restructuring of entitlements, what would be the first 3 steps that the Republican Party, if it had its way, which it does in the House, what would it do?
Well, in fact, we've put forward that plan, and what we haven't seen from the other side is a coherent plan that can actually be looked at and criticized in very specific ways. And we put forward that plan through what the Republican budget. We passed it in the House of Representatives, and what it says is that you've got to reform Medicare, Medicaid, and Social Security, the entitlement programs that drive the largest portion of our budget. In terms of Medicare, what we say is that those 55 and above will see no changes to the current proposal. And those under the age of 55 will see significant opportunities and options to be able to choose the kind of health care that they want for themselves. And the reason that that's important is that the current Medicare program, we had the Medicare trustees before our Ways and Means Committee last week, and they've said that the Medicare program is going broke. So Medicare as we know it has already been modified, has already been changed, has already been significantly decreased through the current proposals of and programs of the President of the United States. So it's not that it's Medicare as we know it forever and ever. It's that they have already changed the program. And then Medicaid, we propose that the Medicaid program be block granted to the states. It's in essence the way that the welfare program was saved in the 1990s. It's one that gives certainty at the federal level to the budget and allows for states to have greater flexibility in how they cover their uninsured population. So what we have put forward are very specific proposals that allow individuals to attack, yes, to demagogue, yes, but what we hoped that would do, and maybe we were a little too hopeful and optimistic, was to begin a conversation about how do we address these challenges that we face instead of just swiping at each other and spitting at each other.
You know, I will say the Republicans have put out very detailed plans on how to get to these areas. Is there room for compromise, though? I mean, some of the things that we'd heard this week even would be that the number would be closer to $3 trillion. Maybe there would not be tax increases that went along with that, but maybe some of the bigger cuts would be things that could be structural actually put into place to kick in after 2012.
I think there is, but you can't compromise with a speech.
Right.
You got to have a plan on the other side. And what we put forward is that plan. We had hoped that a counter proposal of a real specific plan would come back. So then you can have the discussion about what do you do with Medicare? How do you save Medicare? We save Medicare. The president's proposal and the president's plan last year, we believe, destroys Medicare as we know it. We save Medicaid. The president's proposal makes it so that you actually increase the burden on the states, and everybody knows that you can't continue and sustain that kind of challenge, and you can't continue spending more money than you take in.
I overheard a conversation yesterday. I was sitting in a restaurant, and I overheard a woman who was probably in her 60s saying, those Republicans are destroying everything. They want to change the way we do business. Well, what do you say back to a constituent who says something like that? You guys are making broad-based changes. How do you answer those
I think what we're doing is getting back to fundamental American principles, and that is individual responsibility, making certain that the system works in a way that allows those wonderful entrepreneurs across this great nation to thrive. Job creation, we haven't seen significant job creation at all out of the kind of proposals that have been put forward by the president. In fact, we've seen significant decreases in jobs, and that we can't continue down this path.
Cutting
right
government
now.
spending will result in more jobs.
Absolutely. Every job, every dollar that the government takes out of the private sector is a dollar that the private sector doesn't have to create jobs, to expand their business.
So
and the uncertainty in the market that Mr. Peebles talked about just a moment ago is phenomenal. When I talk to entrepreneurs and when I talk to business folks, small and large businesses across this nation, what they say is would you expect me to invest in this kind of market when we don't know what the taxes are going to be? We don't know what the rules and regulations are coming from EPA or the health department or NLRB or on and on and on.
The Greek people who are protesting today should be assured that when austerity comes to their country, the jobless rate will go down.
Certainly over a period of time, if they do the right things, it will go down of necessity. But
aggregate demand does not shrink?
Look, the challenges that Greece has right now is where we don't want to get to. We at this time, which is what we believe with our proposal, we have an opportunity in this country, a wonderful opportunity, to turn this around before we get to the remarkable challenges from a financial standpoint that we're seeing in other countries across Europe.
Do you hold out hope that there will be some decision that's meant? I mean, do you hold out hope that there's going to be something that really looks to significant cuts in the budget that gets passed?
I sure hope so. That's what we have to do. You can't. We've had 1.4, and 1.6 trillion dollar deficits in each of the last 3 years. Right. You can't continue.
But come on, with all due respect, George Bush was president for 8 years. President Obama walked into a disaster when he came into office. Now, I don't agree with every one of his policies, but he walked into a complete disaster. The nation was near a depression.
There's a reason for spending like that, but there has to be a time when it ends.
Sure, of course. And also Medicaid, Medicare was broken before he walked in the door.
Sure.
George Bush presided over 8 years of a failed system. And Medicare, Medicaid, especially Medicare, is fundamentally unsound because Americans are living a lot longer.
You really don't want to argue that we're in this situation because of President Bush, do you? Look,
come on now.
This country for a long time has done a lot of the wrong things in terms of spending. There is no doubt about it.
Sure.
But they have increased exponentially over the last 3 years. We had $5 trillion in deficit spending over the last 3 years. That's not the kind of deficit spending that occurred before. You can't
Medicare is being rated for the health care plan, too. I mean, that's the other part. You're right that these are problems that have built up over decades.
Yes.
And absolutely.
And Obama has been the first president, frankly, that's had the courage to step up and be willing to try an alternative solution to the
George
failed
Bush
health care
tried to take
system.
on Social Security.
Yeah, he did.
And ran into
All I know is it's a little unnerving to have this conversation while watching the rubber bullets out of Athens live. I mean, that's instructive. We don't want to go there.
You're absolutely right, and that's why we believe there's a positive way to solve these challenges that we face, so we can get job creation.
Congressman Tom Price, thank you very much. Good to see
you
you again. All right, our next guest is not hopeful about the potential outcome in Greece. These are some live pictures out of Athens where I guess, Beck, they're using an umbrella as some kind of, maybe that's just fallen. But maybe they're also using it as some kind of shield from the rubber bullets or the tear gas canisters. Parliament, of course, set to vote on an austerity package about this time tomorrow. And our next guest says the crisis could have big implications on these shores as well. Martin Feldstein is the President Emeritus of the National Bureau of Economic Research, which officially calls recessions. He's an economics professor at Harvard, former chair of the Council of Economic Advisors under President Reagan. Marty, good to see you again. Good morning to you.
Good to be on with you.
You've written before many times that the default is inevitable. And as you look at pictures like this today, I guess I'm wondering, is it going to come sooner rather than later?
Well, they may pull it off. They may find some way to get the funds from the IMF and the European Union to prevent a default, but it's just a question of time.
What kind of time? I mean, how long will these patches have shorter and shorter durations as we go on? I mean, if
they're lucky, they'll manage to do this for, say, 3 years. That'll give the banks time to unload some of this debt, the insurance companies time to unload some of this debt, sell it off to the national banks, sell it off to the European Central Bank, so that when the default comes, it won't bring down the private banks and the private insurance companies.
Right. And do you think that's a reasonable scenario?
I think, yes, I think it is. I think it's something that worked in Latin America in the 1980s, and I think it could work in Europe now, as long as this doesn't spread to Spain. Spain is so much bigger than the three that are currently under the microscope.
So what do you make of the yields on Spain and Portugal, I guess particularly Spain, rising in recent weeks?
Well, they should be rising. The question is, shouldn't they be rising substantially more? And the truth is, we just don't know what's happening inside the savings banks, what's happening with the provincial governments, and that's where the big risks are in Spain.
I guess the idea would be allow this to happen, as you said, more slowly and over a period where the economy could withstand the blow a little better. But I'm guessing you don't think that the economy is going to be able to sustain the blow any better in the near future.
Well, it's not the Greek economy. It's in terrible shape, high unemployment, falling GDP. No, it's in awful shape. But what will be improved if they can keep the balls in the air for a few years is the financial conditions of the commercial banks and the insurance companies, so that when the inevitable default happens, it won't bring down those institutions.
But Marty, if we're already talking about the default happening, and last week on Squawk we had a turnaround specialist who studied this say that this is never going to ever happen, that the country can never pay back its debt. It would need GDP to run at 15% for the next 7 or 8 years in order to pay back, even with these austerity measures. And once everybody realizes that that's the case, isn't the negotiation, isn't the gig kind of up at that point?
Well, so far they're keeping it going, and they're keeping it going by saying, we're not asking the private sector to voluntarily lend. We're going to find ways of indirectly providing credit to Greece so that it pays its bills. Greece doesn't want to default, so they'll keep it rolling. But at some point, it will be in everybody's interest to write down the Greek debt, probably by 50 or 60%, so that they can actually have a viable future.
What are the exact parallels between the situation in Greece and the situation in the United States?
Oh, there are very, very few parallels. I mean, the situation in the United States is serious, but there's no doubt that we can, simply by cutting our growth of entitlements, by going after some of the tax expenditures, be able to close our long-term fiscal deficit. Greece cannot possibly do that.
I see Trichet's out on the wires this morning as well, reiterating that the ECB is in strong vigilance mode. Does a rate hike in Europe make any sense at all to you right now?
It does for the Europeans, because remember, Europe is a unionized economy. The United States is not. In the U.S., only 7% of all the private sector workers are unionized. In Europe, it's the overwhelming pattern is to have union membership. So the unions there have to be persuaded that inflation is not going to keep eroding their incomes. Otherwise, they're going to press for increased wages, and that'll set off a wage price spiral. So what Trichet is doing, and what Mario Draghi will do when he succeeds Trichet, is to make it clear that keeping inflation down, even if it pushes the economy weaker and weaker, is the primary objective of the ECB.
To turn back to the United States, what has to happen? I know you said that there aren't a lot of parallels between Greece and the United States, but what has to happen now to make sure that we aren't facing a similar situation down the road?
We have to take the numbers seriously. You know, when I hear them saying we're going to get a $2 trillion reduction in the national debt over the next 10 years, I think that sounds like a great headline, but it's really small relative to the size of the problem. The Congressional Budget Office tells us that at the end of the decade, we're going to be looking at something more than $20 trillion of national debt, 100% of GDP, an increase in the national debt of about $10 trillion during the decade. So to slice $2 trillion or $3 trillion off that really isn't enough. We really have to turn the direction of growth of the major entitlement programs of Social Security, of Medicare, of Medicaid. Otherwise, this is just going to continue to deteriorate.
Yeah, Marty, Don Peebles, you made a very strong case that the stimulus dollars were not sufficient to offset the loss in productivity or the loss of funds in the economy from the housing drop, for example, the loss of Americans' wealth in housing, and you felt that it had come short by hundreds of millions of dollars a year. What's the solution to move our economy forward to start creating jobs? What could the president do to turn things around for us?
Well, we can't go back and redo the so-called stimulus package. That was badly designed. We spent over $800 billion as a country. We added that much to the national debt and got very little to show for it. So I think we have to change the direction of long-term spending so that we give people confidence that taxes aren't going to rise. I think we've got to tackle the housing problem. House prices have been falling for 8 months in a row. We're going to get a new Case-Shiller number again today, and the odds are it'll tell us that once again American homeowners are losing value in their houses, and that cuts back on consumer spending. So I think fixing that is important. And the third thing is small businesses. Small businesses are having a hard time getting credit because of the situation of all of the local community banks that loaded up on commercial real estate and are now in trouble. So those are some of the problems that need to be tackled in order to get the economy going.
Well, it's all going to come to a head here in the next few weeks and months, Marty. We hope you come back soon.
Look forward to being with you again.
All right, thanks a lot.
All right, the fight over reducing the budget deficit here in the United States and raising the debt limit, that is escalating. President Obama meeting with Republican leaders yesterday, and on Thursday, the Senate Finance Committee holds a hearing. CNBC contributor Jim Nussel is scheduled to testify there. He was the director of the Office of Management and Budget from 2007 until 2009. Also with us this morning, our guest host, Don Peebles. And Jim, we just heard from Marty Feldstein, who says that there are not a lot of parallels right now between Greece and the United States, but he laid out a pretty clear plan for what he thinks needs to be addressed in order to keep us from getting to that state over the next decade. What do you think needs to happen?
Well, I think he gave an excellent prescription and outlined, I think, a recovery path for us that is very important. And let's review them again. He said, reduce spending, control spending, number one. Number two, get confidence back into the marketplace, long-term confidence. Uncertainty is breeding a lot of challenge in our marketplace right now. And third, get the consumers back into this by finding the bottom to the housing market, because there's $2.5 trillion sitting on the sideline that is not involved in this economy. It's waiting for confidence. It's waiting for certainty in order to jump in. And Congress needs to wake up. Otherwise, I understand he's right. We're not Greece, but I have to say, every time I heard the noise outside the window from the Greece sound bites, I keep looking over my shoulder here to make sure it's not outside. Because I got to leave here in a few minutes, and I want to make sure it's safe to go out in the streets of Washington.
You have to keep an eye on what's happening, but you mentioned the idea of finding a bottom for the housing market. That's a lot easier said than done. We're expecting Case-Shiller numbers later today, and that drop could be about 3.7, 3.8% in home prices once again, which a lot of people say this is the double-dip recession for home prices, at least.
Yeah, and it's so key, and we saw that with consumer spending, the numbers that came out this week. I mean, people are tied up in their homes. That's always been the big asset. It's where people put their wealth. It's where they put their savings. And if they don't have confidence that's there, that it's their nest egg, they're not going to spend in other places. And the fact that everyone is contracting, whether it's business, whether it's individuals, makes it very difficult for the economy to bounce back. And I got to tell you, the X factor in any of this budget deficit discussion, you can cut all the spending you want, you talk about all sorts of things, but if the economy isn't growing, that's an X factor that we have almost always seen when we've gotten back to balance, when we've seen the federal budget and the receipts come back. That X factor is not there right now, and it's hurting, it's dragging whether or not we're going to be able to get back. And as Larry Lindsay said today, you should have seen the Wall Street Journal piece. He puts out, I mean, right now, both interest rates and economic growth, if we went back to some degree of reality in either one of those, you may see a hill that is much steeper to climb, maybe even impossible to climb, compared to what we've got right now.
Yeah.
Well, going back to the housing, you mentioned housing, for example. Washington, D.C., where you are, is a prime example of what it takes for our housing market to turn around. Washington, D.C.'s got the best housing market in the country right now. Reason why is it's one place that people aren't constricting. Jobs are there. There's positive job growth in Washington, D.C., and the government's not getting smaller, unfortunately. So what's happening here is that proves that jobs are what it takes to revitalize the economy. The hardest hit housing markets in the country, Las Vegas, Florida, they're places where there's very high unemployment. South Florida has 13% unemployment. So the key, I think, to how we get the housing market to turn back around is affordability and also access to credit. The consumers have been deleveraged. There is very little credit out there for consumers, and I think that's a part of the problem. So what's the solution to creating jobs and generating more leverage for the consumer?
Well, Don, I think you said it. And first of all, that's a great reaction, I think. I mean, in Washington, D.C., where it's artificial, where the government is creating jobs, is the best market for that very reason. But I think the solution is this. We go through this austerity, U.S. austerity package and come up with a budget deal which cuts spending and gets us back on a path towards some reasonable level of spending, number one. Number two, we have got to go through a debate on tax reform. And not just tax reform, but to make sure that it is there for the foreseeable, predictable future, so we can give certainty to the marketplace. Because people are not making decisions right now based in part, not only, but in part because they can't plan the future with regard to the tax situation, their tax liability, and with all of the debate out here, taxes going up, no taxes going down. I mean, let's put in this stimulus, let's put in that stimulus. People can't plan, and it makes no sense. So I think those are it's kind of a 1-2 punch. Cut spending, get this package done, and allow the debt ceiling to increase, get past that. And number two, reform taxes and give some certainty to the marketplace so we can create jobs.
All right, Jim, I want to thank you very much for joining us today.
Thank you. I'm going to try and go back out in the streets now. I hope those rubber bullets aren't flying here yet.
Good luck. Anyway, we will see you again soon, Jim. And, of course, Don's with us for the rest of the show.
Welcome back to Squawk here on CNBC, First in Business Worldwide. I'm Carl Quintanilla along with Becky Quick. Joe is off this week. Our guest host today is Don Peebles, the chairman and CEO of the Peebles Corporation, also part of the president's finance team in the 2008 election. We haven't had a chance to talk yet about finance this time around, but the quarter ends this week, and we'll see what happens when they're disclosed in a couple of weeks. Switching gears just a little bit, back in this country, New Jersey is taking out a $2.5 billion short-term loan so it can pay its bills for the next 6 months. Phoning in now with her reaction on the Squawk Newsline is analyst Meredith Whitney, the founder and CEO of the Meredith Whitney Advisory Group. Meredith, good morning to you. Good to talk to you.
Good morning. Can you hear me okay?
Yeah, I hear you just fine.
Perfect. Like I were there in person.
Interesting story. They're calling it routine cash management. But others are calling it a sign of stress. What do you make of the Jersey move?
I mean, look, it may be a routine cash management exercise. We don't know the terms. We don't know the pricing of the extension. I mean, this happens, occasionally, maybe even frequently. But I think it's endemic of the larger issue, which is the tax receipts are tracking. This is not just for New Jersey, but nationwide, are tracking right around 2006 levels, and spending is at all-time highs, save for one state, which is Florida. So this is simply unsustainable. unsustainable. One chart that I tried to send you, which is most important, I think, is it's not just New Jersey's total debt burden, and I include the debt that they owe their pensioners and the debt that they owe in terms of these are tax obligated and tax supported obligations in terms of the pension funds for state employees and the insurance and health care, OPEB, for state employees. That is the highest in the nation for New Jersey, but the real risk here is the fixed costs of servicing those. So if you look at New Jersey, they spend about 17% of their entire budget just on servicing their debt, underfunding their pensions, and paying their health care and insurance costs on the pay-go system. So if they were actually to fund their pension at the actuarially required level, it would consume almost 38% of their total budget. There's just not enough cash. There's not enough funds to go around and service all of the strains on the state. And what will happen is there'll be fewer monies to invest in key infrastructure projects. You'll be raising taxes. They're trying to float a millionaire's tax. The state will become that much less attractive, and that's what Christie is fighting tooth and nail against.
Meredith, we know those numbers, but were those numbers before or after? I mean, the state has taken some strides even last week, making some strides in terms of trying to get workers to pay them for some of the costs for health care and pick up some of the other issues as well, both workers and retirees. Are those numbers that you're running before or after those are taken into consideration?
Well, those numbers are before, but when you look at California or New Jersey in particular, they say that it will be several decades to actually get to a funding level. I think it's 30 years to get to a funding level that's 88% funded, and the actuarially required level is around 80%. They're significantly below that, so it takes a long time, and the contributions will again consume more and more of their budget. But again, this is an issue in terms of it's like not paying or paying a minimum payment on a credit card by drawing down a line on another. I mean, this is just
well, the credit line, to be fair, you can almost read into it as positive news, because the idea that a bank would actually lend a line of credit to New Jersey and say, hey, this is a better idea that we'll get paid back from the state of New Jersey than
the
a lot of...
alternative would be worse.
Well,
right.
I think you can look. Banks are willing to lend at a price. So, is the price of what Greece is borrowing at, sustainable? I'm not comparing New Jersey in any possible way to Greece, but surely, if we don't know what the loan's going to be priced at, and it's again, this is a it looks like a tax anticipation note that it's the probability of them getting repaid is high, but I wouldn't read too much into this other than the fact that you're going to see more strains on the states. And the states are balancing their budgets by cutting deeply into their aid to municipals, local localities, and that's what's really going to hurt. So the pain of the states is just upon us.
But I thought part of the idea here is that this is just a line to tide them over until they can get their bond offering put together. It takes longer to put a bond offering together, and as they did back in 2009, they never had to tap that line of credit. It was just something there to tide them over.
I'm saying I wouldn't read too much into this one financing. It could be business as usual. That's not the issue. New Jersey's fiscal woes are far larger than them just accessing a line of credit or a new loan. So I'm not so worried about this specifically.
So the news itself, Meredith, is not moving the needle on your overall muni call, either up or down, right?
No. I think the issue that what you'll see now is as the states have got to are submitting final budgets, you'll see the real pain at the municipal level start to happen next July 1st, and that will intensify, and that's where you'll see the fallout.
And Meredith, Don Peebles. New Jersey is one of raises the other issue, which the big issue you just touched on a bit, is unfunded pension liability. And that's a perpetuating problem. People retire earlier, Americans are living longer, they're able to work longer, but when you have a structure that rewards someone for working 30 years, if they start at 20 years old and they work for the government for 30 years, they retire for full benefits at 50 years old. These are unsustainable levels. California is essentially insolvent because of it. Florida has a huge exposure. New Jersey, tremendous exposure. New York State, all the states around the country. So what do you think in terms of long-term fiscal health for states? Don't they need comprehensive reform pension reform and also employee benefit reforms, and we're beginning to see some of that about what happened in Florida, what the governor did in Florida. I mean, sorry, not Florida, in Ohio, to prompt a discussion on that. And then now Rick Scott in Florida is doing something similar.
You're 100% right. That's exactly what they need, because this is the most looming financial burden for them, and simply unsustainable. While it's upsetting at the individual level to have your payment or your contract renegotiated, contracts will be restructured, renegotiated, I think universally at the state level. And so there are solutions. This is not a dead-end situation, a doom situation. It's just gone to a point where you're in an inflection point where you have got to find solutions very near term before you see larger risks. The largest risk, I think, is paying an unsustainable debt service, and by that I mean into pensions, and reducing funding to education, reducing funding into reinvesting in the state.
Right.
Look, the states have been reticent to sell assets. California still isn't selling assets. There's solutions. I mean, we're 17% as a country, 17% as far as Europe is in terms of privatization of assets. You sell what you can, not necessarily what you should. There are solutions. Politicians have got to get themselves in gear to find the solutions.
Yeah, and that's a challenge, because there's not the political will right now in many states. Florida has a governor that's got the political will and the mandate. New Jersey has a governor with the political will and mandate. And I think, yeah, as you pointed out, this is a political solution as well. But what's happened also is we've seen over this last economic cycle that these unfunded liabilities for these pension funds have forced these pension funds to make more aggressive investments as well, which exposed them to greater losses during the downturn.
Hunting for yield.
As you point out, Rhode Island was recently reviewed by the SEC, and it determined that their pensions, based on their unrealistic return expectations, were 27% higher than they were stating. And you're going to see more scrutiny in terms of return assumptions, carrying values on all of these issues. And I think that there'll be forced political will beyond all this.
Meredith, you've taken, and we've talked about this again and again, you've taken so much heat for your overall muni call. I mean, that would be validated to a large degree by a high-profile default. Is any part of you secretly wishing that happens?
Of course not, but it's sadly, I think it's sadly an inevitability. I mean, there are, I just, when I come up with numbers of the defaults, I mean, I can think of, dozens, large ones off the top of my head. I mean, this is just the sad reality of where we are. It will sting the sharpest when the states, beginning July 1, cut this aid off to local municipalities.
Yeah, the new fiscal year is going to be much different than the last one. Meredith, thank you so much for coming to the phone. Good to talk to you.
Thank you. Have a great day.
You too, Meredith Whitney, the Meredith Whitney Advisory Group.
All right, the market's waiting for Case-Shiller this morning. Also, consumer confidence numbers. We'll get both those numbers a little later this morning. But we've also been keeping an eye on the situation in Greece this morning as well. And joining us right now is Rick Santelli at the CME, our senior economics reporter, Steve Leisman, Howard Ward of GAMCO, and our guest host today, Don Peebles. And Howard, why don't we start by asking you about this situation in Greece as we see some of the pictures coming back and the protests turning a little more violent. What does this do to an investor's confidence?
Well, first of all, this is Groundhog Day. I mean, where's Bill Murray?
Okay.
We saw this movie last year. May and June, we had an economic slowdown here, and we had the crisis in Greece. We had a 16% correction in the S&P, much more significant than we've had so far this year, which has been limited to 7%. We still had a good equity market for the year. But you've heard the numbers before. Martin Feldstein was terrific. The Greek numbers don't add up. It's unsustainable. Debt to GDP of 150%, when you're adding more debt and the economy is contracting, will not work. They can't grow their way out of this. So you can gift them the money, you can restructure the debt, taking the default route, or you can hope that perhaps this solution that there's brewing will work. But chances are we're going to kick the can down the road just like we did last year and try to buy some time. We're really just trying to buy some time to come up with a more elegant solution.
So unless Steve gets his way and the U.S. takes receivership of the country.
Did I say it happened before? That I think the British invaded Turkey when Turkey defaulted on its debt in the 19th century. That's my understanding of what happened. But I'm not saying we ought to do that. I'm saying that Geithner ought to step up the rhetoric. I think that we need to move towards a more permanent solution here, that we don't want to come in every day and have our markets buffeted by the potential for a Greek default. And what I think we found over the series of crises is that leaders will not take decisions until they realize that the cost of not taking that decision is higher. And that was sort of the best example was TARP, when, you know, they didn't do it, and finally they did it when they realized that if they didn't do it, the market was going to tank by as much as it did. And I don't know that we're there yet in Greece, that, you know, even the scenes on the street are enough to say, you know what, we need to make some sort of permanent final solution here.
Okay, you know, it's interesting. I was with Tony Blair, former Prime Minister of Great Britain, yesterday, and the discussion was about the Middle East. We were J.P. Morgan talking about Middle Eastern policy, and one of the things that the Prime Minister said was, with regards to the Middle East, is the more generous we are, the more demanding we should be. Same thing, I think, with Greece and other places around the globe where we spend our money as Americans. This country spends our money. We need to hold these countries more accountable to making structural changes.
Right,
but John, blood from a stone.
Rick makes a good point. He made a good point yesterday, which is that American fiscal moral authority is not where it used to be. And I wonder if America had its financial act more together, if we would have more authority to turn to the Europeans and say, you guys got to get your act together. Rick, that's like throwing a meatball right down the middle of the plate for you to hit.
Are you kidding? This all sounds like a meatball toss to me. Mr. Peebles, Steve, how could we look any country in the eye? How could Timothy Geithner go over there and tell them anything about taking care of their balance sheet? Who are we to talk? I mean, truly unbelievable. The Greeks are doing the same thing we're doing, which is doing the same thing every indebted nation is doing. They have their fingers crossed behind their back, and they're trying to buy time because they have no idea what to do, but they do know it's absolutely, utterly impossible to fix in a short time period what is taking years, if not decades, to amass, whether it's New Jersey, California, Florida, or Greece. The only difference is financial honesty has a timeline associated with it.
Maybe we can agree on one thing here, which is that one place the U.S. may have some moral authority is on the issue of disclosure. Maybe one thing we did right was our stress. Let me finish the thought, and then you can disagree, even though I'm sure you will.
Human rights.
Bother finishing the thought. But listen, one thing we did right was the stress test. We were able to get out there for the financial markets to see where the opacity was in the market, where the potential losses were, and that resulted in us being able to secure our banking system with really hundreds of billions of dollars of capital. And that if they could remove this from the system in Europe, the financial system, maybe we could move on knowing where those losses are.
Well, the reason I said I don't agree, Steve, is because the stress tests, and they did work well up to a certain point, we have no idea how they're going to work down the road. And I'll give you a perfect example. Look at Larry Lindsay's op-ed today. Are we really being honest about normalization of rates or growth in the economy as to how it affects deficits? That's why the disclosure you're talking about only goes so far. In 3 or 4 or 5 years, we may talk then about how how opaque some of the things we are saying today were in the context of better facts.
Howard?
I think that to bolster some of what Rick is saying, that in the last 3 years we've had a 52% increase in federal spending here in the United States, 15% compounded for 3 years. That's pretty big. Deficit as a percentage of GDP, total government debt as a percentage of GDP is very much in line with what the pigs look like. And we're not even including in that calculation the unfunded liabilities from Medicare, Social Security, and Medicaid. And those, as you know, are a multiple of GDP.
But it's two different issues. I mean, the spending over the last few years was something that had to happen because of the horrificness of what we got into.
Some of it did,
that
absolutely.
Needs to be addressed. the longer-term structural problems are things that we have
We
put
have
off
to, we
far
have to
too long.
learn to live within our means, and it's a problem for New Jersey, it's a problem for Connecticut, it's a problem
Howard,
for
can I
New York.
just ask something? We're talking about Greece that has 150% of GDP,
Right.
and the U.S. is approaching 90. So when
Right,
you say
85%.
you look like the pigs,
Yeah.
it seems to me there's a different order of magnitude
Steve,
here.
if we went back 12 months prior to the bailouts of Greece, the Greece
Rate of
debt to
change.
GDP, I think, was around 110%.
Okay.
So it was much closer. But I'm looking at the average for all the pigs. If you take the average for all the pigs, we're right in there.
But we have a currency, we have
We do.
control,
We have
a single
central
monetary
bank
system,
that
a
prints
central
money.
bank.
And Ben Bernanke and his easy street money, is going to continue.
And we're going to
Thank
deflate
God
the
we
dollar
didn't
to
join
try and
the
pay off our
euro.
debts.
We would have been sunk.
Yeah, the challenge is America's a more mature nation now. And as a more mature nation, we now have to go back and adjust some of the things, especially on entitlements. The problem, of course, politically, is once people get entitlements, they don't want to give them up. And the political will has to be there. And what you're going to see happen more now at the federal level, just like Congressman Price said, the plan is to start pushing this onto the states. Basically, Medicaid, Medicare payments will go to the states, let the state administer, and let the states suffer the financial burden. And these states are already under tremendous amounts of stress with the unfunded pension liabilities, the services that they can continue to have to deliver at escalating prices. But structurally, we have to change retirement age. Americans can work much longer than 65 years old. I hope to be productive well into my 70s. So the fact is that we can't give Americans the opportunity to retire at early ages. We're a more productive society. We also have to
You can't change the
restructure
rules
what
of the
we're
game. You can't change the rules of the game for people who have been working under that system for 40 years. You need
Yep.
to make changes now to warn people who are younger who can prepare for it,
Right.
that this is coming. If you're 55 years old and you've been working under one set of rules and guidelines and you've been promised things all along, it's a little difficult to change the rules of the game that late.
Of course, but the systems, nothing's really fair. And people 40 years old may have been working for 20 years in the system as well. So there's got to be some point to what we can and can't afford. And I think that's got to be the standard. California is an insolvent state. It cannot fund its pension liability ever. New Jersey, similar situation.
The problem is a little simpler than that, I think, which is, don't we need a politician to come forward and say, you want X service, you pay Y tax?
Right.
I mean, where did we get this whole notion that you can have X service without the tax, and we can do the tax cuts and the services together? Now, I don't know if the people demanded the services or the politicians foisted these new services on the people. Either way, if you don't want the service, you don't pay the tax. If you want the service, if you want prescription drugs, if you want all of these new things we do, we pay for them, or we throw them away.
Guys, I'm sorry, they're wrapping us. They're yelling at us. We're very, very long.
It's like
at this
credit
point.
card. It's like Americans buying everything on credit. They have it today, pay for it tomorrow. Same thing with services.
Next time,
Howard,
we'll leave
thank
the
you.
top markets, Howard.
Appreciate you coming in here. Steve,
faith.
Rick, guys, thank you. And Don, we'll have more from him through the show. In the meantime, nobody knows the ins and outs of a bailout better than our next guest, who was a key figure at the Treasury Department during the financial crisis. Joining us right now is PIMCO Managing Director and Head of New Investments Initiatives, Neil Kashkari. Also, our guest host today is Don Peebles. And Neil, we've been talking an awful lot about the situation with the debt ceiling today. Treasury is coming out with some tougher talk, saying that this is something that really is urgent, probably pushing back against some of the politics that have come into play, with Republican candidates saying that they're not going to support this, that they don't think it's a big deal, and that the Treasury should be able to make some decisions on what bills to pay come August 2nd. How do you come down on this?
I'm very concerned about it. I think we're playing a very dangerous game of Russian roulette. We need to remember, U.S. Treasury bonds are literally defined as the risk-free financial instrument in every economic textbook around the world. It took decades for them to achieve that gold standard, and the American people, the U.S. taxpayers, have benefited from it because our borrowing costs are lower than they would otherwise be. If we wait, like we did in the TARP, for a crisis of confidence to give political cover for politicians to cast an unpopular vote, we could cause permanent harm and permanently increase the U.S. government's borrowing costs. I'm not concerned about an actual default. U.S. Treasury collects about $2 trillion a year in tax revenue, and the debt service is only about $200 billion a year. But I'm worried about a crisis of confidence that undermines that risk-free gold standard, that premium position that U.S. Treasury bonds have today. And so, to me, I think politicians are playing a very dangerous game. And if they're not careful, they could do permanent harm to the U.S. government, to the U.S. balance sheet, taking an already unsustainable debt and deficit position and making it worse by increasing our borrowing costs.
The Republican politicians will push back and say, wait a second. We don't know what any consequences would be. We don't know what would really happen, but we do know that if we can get our budget under control, that's going to be good news for the debt markets. What's wrong with that argument?
Well, I agree that we need to get our budget under control. I've been advocating for that for a long time, and so that's absolutely true. But we need to do it in a way that does not cause a crisis of confidence in the Treasury market. Look at California in 2009. California had a budget crisis. Although they met all of their debt service payments on time, they paid IOUs to certain vendors. That gimmick has undermined the confidence in the U.S. in California's process, in California's system of government, and their bond spreads have never fully recovered, even when compared to other fiscally strapped states. And so remember, we're playing, it's a volatile game that we're playing with right now, the confidence in U.S. Treasuries. Going into the crisis, people thought that AAA subprime securities were money good. We look back at that assumption and we laugh today. Are we going to look back and laugh at the full faith and credit of the U.S. government? I certainly hope not.
Yeah, I don't think that we're going to be looking back at any type of government default. But don't you think that the financial markets respond positively to a check and balance system, to where there is a big debate on structural financial reform of the U.S. government? You know, and of course, I'm assuming you agree that there is a immediate need for structural reform of how the government does business, especially in the entitlement area and in taxing.
I agree with that 100%. My concern is that politicians today seem to be waiting for some form of event to catalyze them, to force them to make a hard decision. Go back to the fall of 2008. The House voted down the TARP. The Dow then dropped 777 points, and then 4 days later they voted for it because their constituents said, what happened to my 401k? What happened to my savings? We cannot allow there to be a crisis of confidence in the Treasury market. That could permanently increase U.S. government's borrowing costs, doing real damage to our economy.
What do you say, Neil, to the Druckenmillers of the world who say, look, I have bonds, I can handle a technical default, I understand how politicians work and think, and I know that tough love is sometimes effective. Why is that not a valid argument?
You know, I can't understand Mr. Druckenmiller's position on that. When I was at Treasury, we were terrified of an AIG downgrade because if AIG went from AAA to AA, it would trigger thousands of contracts, putting AIG into default. That was one company. Now imagine the U.S. Treasury, the risk-free financial instrument that every other investment around the world is measured against. If we miss a payment by even a day, I have no idea what kind of calamity that will trigger across legal contracts all around the world. I think that he's completely wrong.
And other developed countries that have lost AAA but managed to live with AA?
But again, this is the premium position that we've been enjoying for decades. U.S. Treasuries have that unique position of being the risk-free financial instrument that every other investment is measured against. And so this is not a game of roulette that I'm willing to play, for one.
Neil, you think that the consequences would be fast and furious, or you think that this is something that would play out over the next 20, 25 years?
Well, I think it depends. I mean, an actual default, the way Stan Druckenmiller is asking for, I think would be fast and furious, causing a financial crisis that may make the Lehman shock look meek in comparison. I think what's more likely to happen is not an actual default, but a undermining of confidence in U.S. Treasuries and a gradual erosion and a gradual increase in U.S. Treasury borrowing costs. That'll make an already unsustainable debt and deficit position far, far worse, and without paying down a dollar of debt.
Yeah, but I think that most politicians, I'm sure most House and Senate members, and of course the President, all understand that that would be a tremendous risk to the United States. And so it's in everybody's interest to resolve this or continue this debate within some parameters, and those parameters meaning to protect the creditworthiness of the U.S. government. But I'm curious, how would you think that this discussion should take place? What form of reform, or what would reform look like to you? Because clearly, right now, going the same way we're going right now without reform is unsustainable.
To me, it would have two major components. Number one is get control of entitlement spending. That's where the huge ballooning of our deficit comes from over the next decade, the next couple decades. And number two, fundamental pro-growth tax reform. I think you can do both at the same time, ideally as part of a grand bargain. To me, though, you know, CNBC had an event a couple weeks ago that I participated in, a deficit debate with bipartisan representation. to me, I think both Republicans and Democrats came out at that event that Steve Leisman hosted and said that until President Obama puts his full muscle behind this, we're not likely to see a resolution. And so I would love to see the president put as much energy into deficit reduction as he put into health care reform. I think if he steps to the plate with that kind of energy, then I'm confident we can get it done.
Neil, you not only understand how bond markets work, how markets work, but also how Washington works. So for those politicians who were involved in the talks, who've boxed themselves in perhaps with this unyielding rhetoric, how would you give them the political cover to do what you're asking them to do without playing tough on the debt ceiling?
Well, I think they're going to have to. I think, for example, Republicans have drawn such a hard line in the sand that said no taxes at all. I think that there's going to have to be some form of, eliminating deductions, which you could maybe say is not a tax increase. It's just eliminating loopholes. I think that there are band-aids that you can put around it to give them some of the political cover that they need. But at the end of the day, the leaders, both parties, Republicans and Democrats, need to step up and need to recognize what's at stake. Remember, if we drive up our borrowing costs, we're going to make our debt and deficit situation far, far harder to solve. And I hope both Republicans and Democrats recognize that today.
Neil, PIMCO has really steered clear of treasuries and said that they don't want to be there for a lot of the reasons that you've laid out. But if there is an agreement between the two sides on this, some sort of compromise and some sort of look at really getting the budget deficit under control over the next 5 to 10 years, would that change the firm's position on all of this?
Look, I think it would help, but at the end of the day, we're making investments where we find the most attractive risk-adjusted returns. And so today we're in an era of quantitative easing still, where we have negative real rates. And we look at other countries, such as Canada, such as Australia, which are providing similar type credit risk, but much more attractive return for our investors. And so it's not just the credit quality of the United States, it's also where else we can invest our clients' money. And while the Federal Reserve is driving interest rates so artificially low, we're finding more attractive investments elsewhere, including in equities, which are having much higher dividend yields than the actual real yields of the Treasury market.
All right. Neil, we want to thank you very much for joining us and hope to see you back here on the East Coast again soon, okay?
Thanks a lot, Becky. Good to see you.
Okay, appreciate it.
Some parting shots from our guest host this morning, Don Peebles, the chairman and CEO of the Peebles Corporation, who knows a thing or two about campaign finance. Big piece column by Andrew Ross Sorkin in the Times today, sort of looking at Wall Street's willingness at this stage to help finance the president's re-election campaign. Uphill battle or not?
I think, a steep battle, but not completely uphill, but certainly an incline. I think that it's very difficult. The president certainly took a lot of shots at Wall Street. Through taxes, through vilifying Wall Street to a degree, the early rhetoric in his administration, and also the economic policies of where that's taken us makes it a little more difficult for a lot of the Wall Street supporters to come back. And also, the second time around, is never as good as the first time. There's a song that says that, by the way, so I didn't come up with that. But the fact is, the first time around, President Obama was a transformational candidate. He was a new candidate. He was transcending race. He was an example of how great America is as a nation in terms of diversity, young, excitement, a lot of young people involved, the use of internet and technology and campaign fundraising. So a lot of that came together. I think the expectations are greater this time around, $1 billion, so it's going to make it more difficult.
Don, thank you very much. It's always a pleasure having you here.
Thank you.
Again, Don Peebles, that does it for us today. Right now, it's time for Squawk on the Street.